Hello everybody, welcome to my free Forex Trading course. In the last class, we talked about the different types of charts. We mentioned the different types of charts. Say we have line charts, we have the bar charts, and we have the candlestick charts. We said the line chart is a line that joins opening and closing prices together, and I showed you a line. It's just like a line that indicates. While the bar chart has highs, it has highs and lows, and so on. But I also show you an example of a candlestick, how a candlestick looks like. This, I believe all of you have downloaded your MetaTrader 4 now as your trading platform. If you have not downloaded it, go to Play Store and download it. And the last time I told you that I was going to show you the line charts, the bar chart, and the candlesticks in MetaTrader 4. Here is it. Let me show you now. This is your MetaTrader 4. This is a chart here. But how do you change the chart? Let's say you want to use line chart. How do you change it? You go to settings. This settings here. You click on it. Then you scroll down. Here is it, where we have charts. You click on it. So if you want line charts, you choose line chart. Then you click on this here. You click on it. Let me choose another instrument. Now look at this. This is a line chart on your MetaTrader 4. This is MetaTrader 4 mobile. We have MetaTrader 4 for PC, but I'm using this one as an example. So this is a line chart. You can see the line. You can see it. Let me zoom it. Can you see it? That's it. Look at it on a landscape. That's a line chart. That's a live line chart for you. And if you want to change it to bar chart, you repeat the same process. You go to settings. Go to settings. You click on bar chart. You repeat the same process. Can you see it? You see those bars I showed you the last time. Let me zoom it more. You can see it. You can see where the price is. This is a Saturday. That's why the price is not moving. So assuming it's a market day, it will be moving. You will see how it will be moving up or down, depending on the time frame you put it. This is weekly. This is a weekly time frame here. As we proceed, I'll tell you about the different time frames we have in Forex trading. Then if you want to put it on candlestick chart, repeat the same process. You choose candlesticks. You see it. You can see the candlesticks. You can see that I use green and red. You can use any color, as I told you in the last class. But default, if you download your MetaTrader 4 now, the color you see there is white and black. White for bullish candles, white, black for bearish candles. So you can see it. This is a candlestick chart. Most people use candlestick chart. Why? Because it communicates better than the other types of charts. It shows you it tells you a lot about the market. It tells you a lot about what is happening in the market, and that's why we are going into today's lesson, which is candlestick pattern. Candlesticks pattern. Now let's go. So today we shall be looking at candlestick long bodies, candlestick shadows, and candlestick patterns. Now let's go. Candlestick long bodies. Can you see these two candlesticks? No, sorry, 4. There are 4 here. Candlesticks have different bodies. They have different types of bodies. Some can be long, some can be medium, some can be small. You can see this one here. Look at this white one. Look at this white one here. This, and this. There are 2 there. They represent the bullish candlesticks. This one is long. This one is long, while this one is small. Now, what does that mean? That means something. When you see a long candlestick, it means something is happening. Same way to these black ones. Long, short. Long versus short. And you see the 2 of them. See this small one and this big one and the small one. They represent something. When you see a long candlestick, it means either the buyer or the seller is aggressive. Now, let's continue. Long bodies refers to strong buying or selling pressure. If the long candlestick is a bullish candlestick, when I say bullish, that indicates buyers. So if it is a bullish candlestick, that means buyers are strong. So long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger. Remember what I told you in the last class. A bullish candlestick starts from the open because it's going up. A bullish candlestick goes up while the bearish candlestick goes down. Bullish candlestick signifies buyers, while the bearish candlestick signifies sellers. You know, sellers want price to go down, while buyers want price to go up. So when the price is going up, the opening price will be down. while the closing price will be up. That's what I'm trying to say here. So this indicates that buyers are stronger and they are taking control of the market during this period of time. Conversely, if there is a bearish candlestick in which the open is above the close with a long body, this means that the selling pressure controls the market during this choosing time frame. I told you before. You see, the opening price is up and the closing price is down. That is a bearish candlestick, and that signifies that sellers are taking control. If the candlestick is long, you see it, bearish candlestick goes down. It goes down, 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 down. While the bullish candlestick goes up. So it tells you what is happening in the market and what is likely to happen. Short and small bodies indicate a little buying or selling activities. You can see those candlesticks I showed you. You can see them. They indicate little buying. For example, this one means little buying pressure. It means the buyers are not pressurizing the market. The sellers are not pressurizing the market. So it means little pressure. Now, candlestick shadows. What do we call candlestick shadows? You can call it tails. I showed you in the last class too. The upper and lower shadows gives us important information about the trading session. Upper shadows signify the session high. We call that the upper shadow. We call it high. I showed you in the last class. The lower shadow signifies the session low. You know, we have talked about the various trading sessions. Now, candlesticks with long shadows show that trading action occurred well past the open and close. Can you see this? Look at this long upper shadow. This long upper shadow. See. What does this mean? Sorry for that. I have press something. So, look at it. What does this mean? It means price opened here. It opened here. Sorry. Price opened. Price opened here. This is where price opened. But this is a bearish candlestick. Price opened here. It went down up to this very moment. Then it went up again and got to this place. Then came down again and closed here. So what does it mean? It means price got here, price got here, price got here, but they didn't close there. Didn't close there. Why? Why didn't it close there? There was pressure between the buyers and sellers. So the sellers, they pushed the price down to this place. The sellers pushed the price. They pushed the price from here to here. The same thing happened here. Same thing happened here. And see how buyers push the price from here to this place. They push it. Sorry about that. I don't know what's wrong with this thing today. So, as I was saying, the buyers push the price to this place after the sellers pushed it. The sellers pushed the price here, but the buyers pushed it back. That's why we have this long shadow here. So, now, Japanese candlestick with short shadows indicates that most of the trading action was confined near the open and close. If a candlestick has a longer upper shadow and short lower shadow, this means that buyers flex their muscles and bid price higher. That's what I was explaining the other time. But for one reason or another, sellers came in and drove price back down to end the session back near its open price. If a Japanese candlestick has a long lower shadow, and short upper shadow, this means that sellers flash their washboard and forced price lower. But for one reason or another, buyers came in and drove prices back up to end the session back near its open price. That's what I was explaining the other time. You can see it again. See. Buyers pushed the price here, but the sellers came in back and drove it down. So that's it. So sorry about this today. Now, candlestick patterns. Now, let's go into the main topic for the day now, which is the candlestick patterns. There are different types of patterns. There are so many, but we shall talk about the major ones. Now, candlestick patterns are one of the most powerful trading concepts They are simple, easy to identify, and very profitable setups. A research has confirmed that candlestick patterns have a high predictive value and can produce positive results. Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you don't speak the language. Do you hear that? Candlestick patterns are the language of the market. The reason why most traders use the candlestick charts. Most traders use candlestick charts. Why? Because candlestick patterns are the language of the market. So it tells you what the market is doing. It tells you what the market has done because of the patterns. With a line chart, you may not be able to get some things, even with a bar chart. But with candlestick charts, is a language. It's telling you something. Once you open the chart, you already know what has happened and what is likely to happen after what has happened. Why? Because there's a saying that there is nothing new under the sun. So if you have a particular pattern, there is a likelihood of what is supposed to follow it due to history. In the past, when we had this pattern, this was what happened. So now that we have the pattern again, this is what is likely to happen. That is how forex traders take their decisions. Nobody sees the future. We don't see the future. We only use the history, the past, to tell about the future. And that's why people make profit. And that is why there's nothing like 100% profitability in forex trading. Why? Because we don't know the future. We don't know the future. Nobody knows the future. It's only God that knows the future. That is it. How could you live if you can't even say a word? It's tough, right? The same thing when it comes to trading. If you know how to read candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trader's behavior. This skill will help you better enter and exit the market in the right time. You know, the market is all about entry and exit. That is it. You enter, you get out. You don't stay in the market forever, or else your money will be gone. Your money might be gone. Let me say might be gone, because if you are lucky and the market keeps going in your direction, that means you make profit, supernormal profit. But you have to get in and get out. That is it. So in other words, this will help you act differently in the market and make money following the smart guy's footprint. Candlestick pattern has worked in the past and is still working up to today. So if you can read the patterns, you don't need to cram it. All you need to do is just to understand it. Just to understand what happened there, why it happened. Then you are good to go. Now, let's go to the first candlestick patterns. Number one, we have the engulfing bar candlestick patterns. Engulfing bar candlestick patterns. The engulfing bar has its space in its title. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candlestick. That's the previous candle. The engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. There are two types of engulfing bar candlesticks. We have the bearish engulfing candlestick pattern and the bullish engulfing candlestick patterns. Now look at this bearish engulfing candlestick patterns. When do we say that a pattern is bearish engulfing? The bearish engulfing candlestick pattern is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. It consists of two candlesticks, two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. Now see the illustration. Sorry about this. I'm so sorry about this. Look at the bearish engulfing bar. You can see. Look at the first one. Look at the first candlestick, the white one, and the black one. You can see the way the black one covered the white one. This is what we call engulfing bar. What does it mean? It went lower than this white one. Look at it. The small body. See the opening price. See the closing price. It completely went lower than the bullish candlestick. This white one is a bullish candlestick. The black one is a bearish candlestick. And it went far lower than the first candlestick. This is what we call bearish engulfing bar. Once this happens, it means the sellers are getting back into the market or are stronger. So it shows the strength of the sellers. Now, in case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, let's say the market price was moving up, jumping up, going up, then suddenly you have a bearish engulfing candle or bar. That means sellers are gaining back control, or that means there is a reversal that is about to happen. So when this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. See the example. Look at this example. Look at this example. You can see price was going up. And see the way price was going up. It kept going up until it got here. And what happened here? There was a bearish engulfing bar. You can see this candlestick completely went lower than this small one. So, and what happened next? Price started going down. You can see this arrow started going down. Why? Because there was a trend reversal. Because of that pattern that happened. So once you see that, it signifies a trend reversal. Especially if price was going up before, as it was going up here. And suddenly you have this, a strong candlestick, a strong bearish candlestick, completely engulfing the previous candlestick. So it signifies a trend reversal. So, as you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. Now, does it mean that once you see this in the chart, a trend reversal, or does it mean that once you see a bearish engulfing bar, then you just click on sell? Does that mean that you just click on a sell? No. You can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm your entry. You have to confirm it. And it has to happen in a zone. What do we call a zone? You have the seller zone and the buyer zone, support and resistance. Is it happening in a major seller's zone? That must be the first thing that you have to consider. Is it happening in a seller's major zone? If yes, then that means you can trade it. And you also use some of your tools to confirm it. So you must confirm it with some of your technical tools also. So if all of them agree, then you go on with the trade. So you don't just use one. Don't just use one thing to decide. Now, the second one is the bullish engulfing candlestick pattern. This is just the reverse of the bearish. The bullish engulfing bar consists of two candlesticks. The first one is the small body, and the second is the engulfing candle. You can see the illustration. Look at this. You can see how the big white candles completely went higher than the small candle. See, look at it. It's opened here. This one closed here. This one closed here. And this completely went higher and closed here. Completely went higher, closed here than the previous candlestick. So when you see something like this, this is a bullish candlestick pattern. So it signifies that buyers are likely to gain control, especially if it happens in a buyer's zone, a major buyer's zone. Now, the bullish engulfing bar pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. That's what it signifies. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation. Let's say price was going up. Price was going up. Then suddenly you see a bullish engulfing back candle again. That means price will continue up. Or price was going down, then suddenly you see a bullish engulfing bar in a major buyer's zone. That's in a support, a major support zone. So it means a reversal is about to happen. So you can get ready to buy after you have confirmed it with other technical tools. So when a bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation bottom. See the example below. Look at this. Price was going down. It was going down. Then suddenly, there was a bullish engulfing candle. Look at this box here. Before you know it, price started going up. So that's a bullish candlestick pattern for you. The example above shows us clearly how the market changes direction after the formation of a bullish engulfing bar pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What is important is that the smaller one is totally engulfed by the second candlesticks. Don't try to trade the market using this price action setup alone, as told you before, because you will need other factors of confluence to decide whether the pattern is worth trading or not. As I told you, I said it must happen in a major zone, a major support. What support? Support is a point of reversal that takes place when price is going down. Price is going down, then it gets to that support and it starts going up again. That's what we call support. Just like support, you are standing on something. Price is going down, then it gets to that particular place and it starts going back up. That's what we call support. While resistance means price was going up and just like hitting the roof. Price was going up, then it hit the roof and start going back down. So those are what we call support and resistance. So today we shall come to the end of the class. And please, if you have not subscribed to my channel, maybe you are new to this course. This is a free trading course. And if you have been following me, you know you have been gaining something. You will have been gaining something. You just follow me step by step as I take you. Please make sure you support me by subscribing, like my video, subscribe, and hit the notification bell so that when I post the next one, you get the notification. So sorry that about my presentation today. The thing was just messing up. So I'll correct that in the next class. So see you in the next class.